This is the Daily Market Rundown live from the Tradelo trading floor. It's August the 7th. Some highlights from today's show. Trump and Putin to finally meet. The US 10-year auction tails by 1.1 basis points. And gold is now in play to the downside. Good day traders and welcome. I am back at the desk, and so let's get stuck straight into it. Topic number one today is all about ultimately the tariff situation. There is of course a lot of things going on from a tariff perspective. A lot of it is mostly noise. I think one of the key things to take away from not just of course the current tariff headlines, but perhaps the tariff headlines of the last 3-4 months is that it is being used as a negotiating tool with a very much a core focus. And I think this is what we're learning. The core focus from the presidency is, yes, to onshore perhaps some manufacturing, but it's the manufacturing that is of course of national security. And we've seen that again now with the chip situation, where they want to ultimately put 100% tariff on imported chips. And so the US government is very much focusing on onshoring strategic manufacturing, as well as of course setting up deals where ultimately they do put some form of tariff on countries. They don't want to of course have no trade between countries, but they put some form of tariff with the view of ultimately getting those countries to perhaps open up their markets for US goods, as well as of course investing into the United States. So this is the United States government strategy right now. It's very apparent that this is what they want to do. And why this matters is because whenever we get headlines now, for example, like what's happened with India, okay, there is a strategic proponent to why ultimately these tariffs are being hit. What is it? Well, ultimately the US government wants to force India ultimately to reduce their demand of Russian oil so we can have peace between Ukraine and Russia. In other words, all of the tariff headlines you're seeing are effectively a part of a bigger strategy, okay? And it's to get some form of action out of those countries. It's important to stress that, because how it works is ultimately we get the tariff put in place, we get the escalation, and ultimately eventually we get the de-escalation, and the US government seemingly gets what they want. Now, one critical thing to pay attention to is who is paying all these tariffs? And this is the question, perhaps the million-dollar question that everyone wants to know. And there was an article in The Economist out on the weekend, and the way they have framed it is effectively 1/4, in other words, 1/4 of the tariff is being absorbed or paid by the exporting countries. Okay, so when the EU sells goods to the United States, effectively they are having to lower their prices by 1/4, or at least absorb some of that tariff, so that the US company buying those goods can effectively still buy them and be competitive. Okay, the other 3/4, in other words 75% of the tariff, is being consumed by one, the company, the US company, and two, ultimately the US consumer. Okay, now why does this matter? Well, because the presidency of the United States is talking about this idea that there's loads of revenue coming in. And yes, there is loads of revenue coming in, and there will be a lot of revenue for the US government. But it's not coming from the exporting nation. It's coming primarily from US companies and US consumers. Okay? Now, the way to think about this, because ultimately we need to try and understand the implications of this. The way to think of it, it's very much like a tax. Think of it like a tax. Think of it like suddenly the government comes out and says, look, we're raising corporation tax by 10% and we're raising VAT by 5%. That's effectively what is happening. It's a tax on US companies and consumers. Now, some part of the tariff US companies will absorb on behalf of the consumers, so they can still sell them goods. And what that means is there'll be a margin squeeze. In other words, yes, they will still generate revenue, but perhaps their profit markups are not going to be as high as expected. Now, why does this matter? Well, we are getting to earnings season. It's been a fantastic earnings season once again. Ultimately, the markets are now pricing in, very, very high earnings expectation into the end of the year, which is why a lot of particular mags have not record high. And what this ultimately means, though, is if we are going to have the situation where US companies are absorbing some form of the tariff, the reality is that those margins are going to come under some pressure in the future. Okay. Moreover, the US consumer is going to bear the brunt of most of the tariff. Okay. What does that mean? Well, look, if prices are high, we demand less. It's as simple as that. Or we obviously change the product we're buying. So we will see demand destruction. For sure, we'll see that demand destruction. And the million-dollar question now is, does this cause a recession or not? We just don't know. Okay, I think for sort of face value, with the US interest rate at 4.25%, obviously they are going to start cutting, but it rates at 4% and now putting a tax on the consumer. My instinct says we have very close to zero growth moving forward. But again, we need to start seeing that in the data before we can actually conclude what to do with that. Okay, and that is the situation of tariffs. That's all you need to know. Yes, there's lots of backwards and forwards with India and the Swiss and South Africa, and some are getting this and some are getting that. All of that's noise. Okay, there's no real signal from that. Obviously, it's all about getting those concessions, and that's what you need to understand about the whole tariff situation in general. Okay, with that in mind, as you can see, the markets don't care. It's just noise. Okay, there's no real signal. Week to date, we can see the S&P's up 2.5, Russell up 2.5, Nasdaq up 2.5. So they're all really performing well, and we can see obviously Europe starting to outperform again. Okay, I think since the Europe got its 15% tariff, the markets have kind of taken it in its stride, and they've said, well, you know what, this ain't so bad. The world didn't end. It's okay, and now we're starting to see outperformance in the European markets. Now, as I said, Trump did impose 100% tariff on imported chips. He is excluding, very important, he's excluding companies that ultimately invest in the United States. Okay, all part of this big strategy to get onshoring, to safeguard what are regarded as sort of security reasons. Products or manufacturing is for security reasons in the United States, but ultimately to get investment into the United States. Okay, and this is why he's come out now and said to Japan, hey, look, we're not happy with you and your headlines and telling everyone that you're going to invest, but it's mostly loans. We're not happy with that situation, so we're going to hit you with more tariffs. Okay, this is the game we're playing. It's very much extract what you can, get the concessions, align it with what the US strategy is, which is now very, very clear for us as traders. And ultimately, if they don't listen, hit them with a tariff until they do listen. Okay, and this is kind of the real line here. It says, Trump says, if for some reason you're building and then you don't build, well, what I'm going to do is I'm going to go and backtrack. I'm going to go and accumulate all the money you should have owed us, and I'm going to charge you. That's the game he's playing. The president is very clear ultimately about what his strategy is. Okay, but like I said, don't forget, 1/4 of the tariff consumed by the exporter, 3/4 consumed by the US companies and US consumer. That's what you need to know. And if that holds true, we are heading for a growth slowdown, and there's a number of implications for what that means for the markets. One of those markets, of course, NVIDIA flying high. As you can see, nice weekly chart. A lot of green, a lot of one-time framing, a lot of steepness. What can go wrong for NVIDIA? It just keeps delivering blockbuster earnings. We keep seeing a lot of positive news around it. And of course, this 100% tariff on imported chips definitely just adds to this narrative. Okay. Will this end? Well, look, this week we've heard a lot of the Mag 7 talk about increasing their capex for data centers. Okay, AI is a real thing. Do not discount that. AI is the future. The rollout for AI will continue, and it seems to be picking up pace. What that means is, yes, NVIDIA is expensive, but hey, it can get a whole lot more expensive. Okay, so just keep an eye on this chart. It is a very, very strong market right now. It can do no wrong. And unless we enter some form of a capex recession or a slowdown in the investment into AI, I suspect we are going to see NVIDIA at much higher prices over the coming months. Okay, with that in mind, very, 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 very positive news. Finally, Putin and Trump are going to sit down. Now, this is the first time a US president will sit with President Putin since 2021. Okay, this is positive. Doesn't matter how you want to look at it. It's really good that the two are going to get into a room and just battle it out verbally. I think we are seeing a lot of positive noise around this. The fact that, of course, Trump has moved away from sort of threatening 100% tariffs on anyone that buys oil from Russia and moved more towards sort of, looking at India saying, hey, we're going to hit you with tariffs unless you reduce that demand. I think that's a far more strategic or a better strategic way to go about it. And the reality is, look, no one wants this war. Okay, this war needs to come to an end. And I think the two of them getting into the room means we are probably going to get very close to some form of a conclusion. Okay, we're near the end point of this war, and I think that's very, very positive. And the markets ultimately are taking in stride. Of course, Russian stock market up nicely today, Russian ruble rallying. But oil ultimately is the one to keep an eye on. Why? Well, look, should we get some form of a truce, it will, of course, open up Russian oil to the broader market again. Not that Russian oil hasn't been on the market, but perhaps it should have some concerns at a supply side, effect on the market. And what we can see ultimately since the start of August, we have started to see a little bit of an unwind of that backwardation. We've almost dropped about 50 cents in terms of the backwardation since the start of this month, and that perhaps speaks volumes to this idea that we are now getting to the end game of this war, and that Russian oil should perhaps throw a little bit more freely around the world as a result of that. With that in mind, we can see oil has taken that tumble. Yes, there was the threat, so we had that threat of 100% tariffs, and that did result in oil spiking, but we've now erased that. We're now back to that 64 level, which was the bottom of the Israel-Iran attack, and it is a crucially important level. I mean, you can see it's acted as both resistance a number of times. It acted as a rally point, it acted again as support, and it's an important level. It's just a level that everyone's going to be watching very closely, and should we start to trade below that, and at the same time we see ultimately further unwind of that backwardation, it is lending itself to this idea that we're going to see more supply come into the market at a time when we are seeing downward revisions of global growth. Okay, don't forget, like I said, all these tariffs going around, all this noise creates a lot of uncertainty, and uncertainty is never going to be highly correlated with economic growth. Okay, so keep an eye on that. Oil, I suspect, at some point in the next 6 months is going to be testing the low of the year. We also know OPEC strategy is very clear. They are going to, they've now completed ultimately unwinding the voluntary cuts, but there are still more supply cuts to be unwound. And I suspect we're going to find out a little bit more about that over the course of the next 6 months. And none of that points to ultimately, a significant rally for oil. Okay, oil's very much in a sell-only mode, unless, of course, we get a re-acceleration in growth. Okay, should AI start to dominate, should economic growth around the world start to re-accelerate, then fine. Absolutely, oil has got a real demand story to ultimately start to rally. But right now, it's not just a weakening demand side equation, it's also an increase in supply of oil. And those two together in tandem don't point towards higher oil prices. Okay, in terms of the data today, we did have a US auction out yesterday. It was a 10-year. It tailed by 1.1 basis points. Now that matters because it's the first time it's tailed in some time. The degree of tail, not necessarily like a massive moment, but it was a tail nonetheless. Now, why does this matter? Well, because we know the general thinking around duration and buying long bonds. There's a bit of nervousness around it, and that's why I've got this chart up for you. This is the US 30-year auction, which we have today, and this is the when issued yield. In other words, this is the yield applied to everyone who wants to buy effectively at auction. In other words, this is the price the US government, in terms of yield, is paying to those holding their bonds. Okay, and you can see why President Trump is upset, where they're issuing 30-year debt at the highest since pretty much 2015 almost. Okay, so if you go back to, of course, 2021, they were issuing 30-year debt at 2%. Now they're issuing it just shy of 5%. Okay, that makes the bill very, very expensive. This is also why, of course, Scott Bessent is moving away from issuing longer dated bonds for now, focusing perhaps on issuing more shorter duration. But the point stands, okay? It was one of the highest when issued yields for a 30-year last month. I suspect the when issued today is going to come in very close to that level, okay? Point is, investors want higher yields, and we've got to keep an eye on that, because at some point, should we see weakening dynamics in the US, perhaps we get an auction where the when issued comes in high, but we get a very weak demand for it. Does it happen today? No, perhaps not. There's perhaps no reason for 30-year yields at 4.9 or when issued at 4.92 to have a weak demand. But it is one thing to keep an eye on, because if they're going to have weak demand at a very high when issued yield, or at least the highest when issued yield in a number of years, it does speak volumes about what people think about the US government and the US economy in general. Okay, but we're not at that point yet. I'd be very surprised if we did get a big tail today. Like I said, don't forget as well, the fact that the US government is issuing less longer dated debt suggests that there is going to be less supply of longer bonds, and of course we still have quite a bit of demand for those bonds. Okay, keep an eye on it. It is a potential potential risk event. Not one I think has a high chance of today, but just watch it in general. Okay, and just for comparison's sake, this is the 10-year when issued yield, and I think there's something very, very interesting to pay attention to. You can see the highest when issued yield for this year is around 4.75% in the 10-year, and of course for the last couple of months, almost the entire year, they've been issuing 10-year debt at 4.36. Okay, so if I just scroll back, you'll notice that the when issued for 30 years pretty much at the highest has been in 5 years, whereas the 10-year is not even close to the high of 2024. Okay, and that speaks volumes about where investors are concerned. They're not concerned about owning 10-year or 5-year. They're concerned about owning the ultra long duration. Why? Well, because what we see going on in the US right now is a situation where there's just a lot of volatility. Okay, and that's typical. Investors don't want to hold duration when there's a lot of uncertainty. So should the uncertainty clear, should the fog clear, by all means, maybe 30-year comes back in terms of when issued yield. But for now, investors are a little bit concerned, and they do just want a bit more yield to own duration. Okay, and then finally, in terms of the bid to cover, there you have it. That is the bid to cover for 30-year. Again, a range to focus on. I think a bid to cover within 2.3 to perhaps 2.45 is relatively normal. I think anything below 2.25, okay, you're going to get a little bit of concern there, because like I said, we should have a pretty solid 30-year auction today, given there's less supply of 30-year auction and still a pretty good US economy. Okay, so bid to cover less than 2.25.
One time framing sell.
Now, play of the day is very much gold. It is tightening up in terms of ranges. The profile looks very sexy today, and you can see gold has very much been in a sideways range since Liberation Day. Okay, since Liberation Day, I was talking on the floor today a little bit about gold and how it feels like gold is very near a major turning point. It kind of feels like it's priced in everything it should price in terms of a hedge against inflation, perhaps a hedge against dollar weakness. It feels like gold is going to need a new catalyst, a new narrative to go higher again, something like a re-acceleration of inflation. But the reality is that gold, I suspect, is closer to a top and a long-term turning point than it is to ultimately another 5 to 10% up move. But that's a long-term viewpoint. For today, of course, we expect more of the same, which is we're going to stay stuck in this range, perhaps until Jackson Hole. I think there we may get some form of a catalyst for the market to move. Should we get a dovish Powell then? Perhaps yes. I think that does open the door to a retest of record highs, but we'll worry about that as we get closer to Jackson Hole. In terms of the profile, you can see it there. It's 3 days of nothing, overlapping volume pointer controls, overlapping closes on the day. We've had a little bit of spike breakout today, so we've trapped in a couple of longs. I suspect we take out the low of today, and we are going to make our way back towards that non-farms range. So we are looking for something like a $60 to $80 down drop. It's going to come pretty quick, come pretty fast. We've got some stale longs here. They're all pretty stale, all sticking around a little bit too long. So we are watching for a break of the overnight lows, looking to sell through there. And then, of course, like I said, target effectively the bottom of the range of non-farm payrolls around that 33.50 level. Okay, with that in mind, that is a wrap for today. As always, if there are any other questions, you can, of course, post them in the Discord channel. You are also welcome to comment, like, subscribe, share it with all your friends. And as always, go manage that risk. Good luck out there. Go make some money.